When you're going to take a loan from somebody, there are three important factors that will determine how much you should take as a loan and what type of loan you should take. Here's what I mean. The three factors are, the first is interest. Like I mentioned, what makes a loan is that there is a cost for every loan, which is called the interest. The interest is the cost of taking the loan. The interest may be 10%, or right now in Nigeria, the interest rates, the bank interest rate for commercial banks, between 30 and 35%. If you are raising funds from microfinance banks or some of all these other fintechs, the interest rates can reach up to 10% a month. 10% a month. If you've been following this so far, you now see what they are doing. The banks are giving away loans at 35% a year. The microfinance banks are giving out loans at 10% a month. So for microfinance banks, they specialize in short-term loans. Microfinance banks specialize in short-term loans that are less than 12 months. And because they specialize in short-term loans, they charge higher for short-term loans. They can give you a loan for 30 days, which is 1 month, or 90 days, which is 3 months, at 10% a month. But commercial banks have a longer horizon. That's why they give away the loans at 35% a year. By the time you prorate it, the bank's loan comes to about 3% per month. Meanwhile, microfinance banks are giving away loans at 10% per month. And the interest can make or mar your business because that is a cost. This is profit that should be coming to you, but you have to pay to the bank. So what it means is that the higher the interest, the more risky the loan is. But again, these things balance, right? If you take a high interest loan for a long period of time, that is devastating. That is the riskiest. You take a loan at a high interest rate for a long period of time, very risky. You take a loan with a high interest rate for a short period of time, manageable. Because even though you are losing by paying a high interest rate, you're only taking it for a short period of time. So there's an advantage to that. Another thing you can do which is also good, is to take a low interest rate loan for a long period of time. That's why you will notice for mortgages. Mortgages are an example of long-term loans. When you want to buy a house, they give you a loan for 15 years, 20 years, 30 years. That's a long-term loan. But what they do is that the interest rate for mortgages are usually lower. They are lower compared to somebody who wants to take a loan for 1 month. So you see what's going on here. If you're going to give somebody a loan for a short period of time, you can charge high interest. If you want to give the person a loan for a long period of time, for it to be sustainable, you have to reduce the interest. The worst thing you can do to yourself is to take a high interest loan for a long period of time. Then that's very dangerous, right? So interest rates, an important factor you have to look at before you take a loan, because the interest is a cost that will come from your business. Can your business afford that cost? You need to find out. So, for example, if you're taking $100,000 as a loan at 10% interest per month, what it means is that you have to pay $10,000 every month. If you don't currently make profits of that amount, or if you don't see that infusing $100,000 into your business will allow you or give you the capacity to earn up to in excess of $10,000, don't touch that loan, because interest comes from your profits, your operating profits. Whatever profit you make, you have to deduct the interest, and it's going to form part of what you're going to pay, right? The second is the tenor. The tenor of a loan is the duration of the loan. I think I've already explained it. The longer a loan takes, the more risky it is. The shorter a loan is, the less risky it is. Which is why, like I just explained, if the loan term is short, if the loan duration is short, they charge a higher interest rate, because you are enjoying low risk. So they charge you for that. If the low period is long, you are taking more risk. So they reduce the interest rate for you. That's the tenor. Another very important factor that unfortunately many businesses either don't understand well or ignore is the timing of the repayments.